Good afternoon, everybody, and welcome to the latest event in our series of Professional Advisors Working Lunches. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for the next hour. As you can see, instead of reading this from my dining room, like I have done for the past 18 months or so, I'm now broadcasting to you from our brand new state-of-the-art studio in London. And in this flashy studio, I'm joined today by Bertie Dannatt, Investment Director at Ruffer. Bertie, thank you for joining me today.
It's a pleasure, Tom, and thank you very much for having me.
Bertie will ask and then try to answer whether we are going to hit an asset allocation crisis. He'll also ask what investors can use to offset equity risk, whether the low return environment is heralded by scaremongering, and how savers can adapt if it arrives. After I finish up my introduction and housekeeping, Bertie will set out his thoughts in a 10 to 15-minute presentation. Bertie and myself will then have a discussion before we bring in questions from you all at home in an audience Q&A session at the end. Do feel free to put any and all of your questions to Bertie using the chat function, which you will find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message so only I can see it. And if the lure of putting your questions through isn't incentive enough, then I should mention that Ruffer has put up an agreeable case of wine to be won in a raffle. Everyone who puts through a question will be entered to win, and I'll pick out the name of the winner at the end of this hour. Now, for the housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It would ensure there's no background noise, so the two of us in the studio can be heard more clearly. If you haven't already, in the Zoom call, can you please pin the PA Working Lunch video feed to make sure Bertie and I are blown up to the greatest size possible within the Zoom window. If we are currently appearing alongside everyone's names, either along the top or down the side of the window, please click on the PA Working Lunches box and select Pin. I should also tell you that this session is being recorded and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending proof of your attendance along with the link of the recording of the session, which will arrive in your inboxes tomorrow. And now for that coveted CPD, here are today's 3 learning objectives. To provide an understanding of the key asset allocation problems facing investors in the context of reopening in developed economies, understand the debate around regime change and the degree to which changes to our economic models might affect asset allocations over the coming years, and explore the possibilities for the path of interest rate and inflation movements over the short, medium, and long term. Okay, that's the housekeeping out of the way. Let's move on to our main event, and let me hand you over to Ruffer's Investment Director, Bertie Dannatt. Bertie, over to you.
Lovely, and a big thank you, Tom, and a big thank you to all at home for giving me an hour of your time on a day where, if we're honest, we've probably all got a hard stop around about 7 p.m. this evening. Now, I'd like to start with the story of 2 goldfish. Once upon a time, there were 2 goldfish swimming along, and an older goldfish swam towards them, coming the other way. "Good morning," said the older goldfish. "How is the water?" The 2 young goldfish quickly swam away, before shortly afterwards stopping, where one of the young goldfish said, "What the hell is water?" Now, in the investment world, the water is akin to the investment regime within which we all operate. And for the last 40 years, it is our contention that that investment regime has been unequivocally disinflationary. What does that mean? It means that the last 40 years have been defined by a period where levels of inflation have been positive, but have gradually fallen year on year. Likewise, interest rates have gradually fallen year on year, all the way down to next to 0. And likewise, levels of volatility have also fallen consistently over that period. And what we can observe, therefore, is that the last 40 years have been something akin to a golden era for investment managers. And this mood, this point, this lack of inflation in the system was neatly captured by Bloomberg Businessweek who published a front cover in April 2019, which you can see on the slide, but on the front, they had a picture of a deflating Tyrannosaurus Rex on the verge of extinction. And above the title, above that picture rather, they had the title, "Is Inflation Dead?" Now, fast forward 24 months, and what we can see is that the financial press is abuzz with stories of rising prices and the re-emergence of inflationary risk. In fact, one only has to look at the US inflation report for May to notice that the month-on-month rise in prices in the world's largest economy for the month of May was the largest since 1981, the year that I was born. And within that too, there are some fascinating little factoids, which I thought, in the interest of livening up your lunch hour, I would share with you. And my favorite here is shown on the chart, and it shows the price action in like-for-like US TV prices. And what you can see is that in the 6 months leading up to the May inflation report, the price of a television in the US rose by a staggering 11%. Over the 12-month period, the price went up by 4.5%. And this equates to the fact that US TV price inflation is now at its highest point since 1957. So clearly, something in the last 24 months has changed. And my strong contention here is that while the financial press are focusing on the right topic, which is inflation, they're fundamentally asking the wrong question. Their focus is how transitory is this pickup in prices going to be? How long is it going to be before the price for a like-to-like TV starts to fall again? Now at Ruffer, we have a different view. And our view is that the global pandemic and the subsequent synchronized lockdown of the global economy, which we've all experienced firsthand, is the catalyst to this surge in prices, but it is not the cause. The cause is that the investment waters within which we all operate are in the process of changing. And we are currently in the midst of a once in a generational shift from disinflation to a new financial system, which is likely to be more prone to inflationary shocks, inflationary skirmishes, the likes of which we're seeing right now. And this new financial system too is likely to amplify these inflationary shocks when they happen, in exactly the same way that the disinflationary system of the previous 40 years amplified the disinflationary shocks. And this really matters. If we're right that the waters within which we swim are changing, then this has profound consequences for financial advisors, for investment managers across the piece. Now, I'm very conscious that I'm interrupting your lunch break and making some pretty aggressive, pretty significant statements here. So let's dig into the detail a little bit. I've spoken about COVID-19 and the subsequent lockdown of the global economy, not being the cause of this inflation, but the catalyst. Where you can clearly see that is in the disruption it has caused to supply chains. And the slide in front of you now shows the exponential rise in shipping rates that has occurred as a result of this disruption in global supply chains, which in effect is as simple as the ships just not being in the right place to take goods from where they're traditionally manufactured in Asia to markets in the West where they're typically purchased. So what we are seeing is that businesses in the West are not receiving the raw materials and goods they require. So they are being forced to draw down on their existing inventory. And as they do that, they're putting up prices. On the other side of the equation, COVID has also catalyzed this surge in prices by creating strong demand in the unlikely source of the global consumer. And hopefully this is something we can all relate to, because over the last 15 months, many of us have been paid to stay at home. And during that time, our savings have significantly increased. To try and put a number on that additional savings, there was a Moody's report out recently, which put a number on that, and they estimate that $4.5 trillion has been added to the net savings pile of the global consumer since the pandemic began. That is akin to 6% of global GDP. So we're at a point now where we have strong consumer demand coming from consumers who are itching to get out of their houses, itching to go on holiday, itching to spend some of that money, meeting supply chain disruption, meeting less goods available for that money to be spent on. And then I think the final way that COVID-19 has catalyzed this surge in prices is because it's created something of a low bar for the inflation prices to be calculated off. So if you look at the price of a notional barrel of oil and compare it today, where it's currently trading at in around $70 a barrel, and compare where it was trading 12 months ago in May 2020, when the global economy was in the midst of a complete shutdown, you'll see that same barrel of oil traded in between $20 and $30 a barrel. So in a number of different ways, it is very clear that the global pandemic and the subsequent lockdown of the global economy that followed has contributed to this surge in prices. But it is my contention, our contention at Ruffer, that to stop the analysis there would be incomplete and also potentially dangerous. And it is right to point out that as a result of that conclusion, we are and would not be remotely surprised if, as we went into the end of this year, the start of next year, if some of this surge in prices that we've seen actually starts to see a reversal of that trend, and some of those prices start tracking down towards their target levels or even below. And that makes sense, because fundamentally, we think the real story here, the real cause of what is going on, is that we are in the midst of this regime change from 40 years of disinflationary pressure to a new regime which has much higher levels of inflation volatility. And what you can see on the slide in front of you is the path that's been taken by the durable goods price inflation set of data across advanced economies. And if you focus on that blue line, what you see is that it was certainly trending upwards right up to the point where actually it broke into positive territory on the eve of the pandemic itself. So this is consistent with the fact that something much more material is going on in the inflationary data. And our contention is that this structural shift to a new investment regime owes its origins to a number of structural drivers which explain that. And the first of which is that after 15 months of economic lockdown, in sharp contrast to the global consumer, which I discussed, national government's balance sheets are completely shot. Just focus on this chart on the blue line. And what you'll see is that looking at time running along the bottom, going back over 200 years, the UK's government deficit as a proportion of its GDP has never been worse. And that includes the state we found ourselves in at the end of both the First World War and the Second World War. And our high conviction view is that the clearing mechanism for this debt will not be a default, a hard default at least. It will not be to meaningfully put up taxes to address that, but it will be through higher inflation to, in effect, enable a soft default. The second structural driver that I want to raise your attention to is the fact that now for the first time since the 1970s, we have the coordination of slack monetary policy. What do I mean? I mean very low interest rates and huge amounts of quantitative easing in coordination with slack fiscal policy. Governments creating money and injecting it directly into the real economy. And our firm view is that if you create money and inject it directly into the economy through furlough schemes, through bounce back loans and other examples of it, then those businesses and those people will spend it. And so what you will see, which is in direct contrast to the previous 10 years, is you won't just see asset price inflation, but you'll see inflation in the real economy too. And then finally, linking back to where I started, we believe the very waters within which we swim are fundamentally changing. Unequivocally, we've lived through a period dominated by disinflation. And there have been some very powerful structural drivers of that disinflation, many of which are up on the screen now. The impact of technology, the emergence of China, political, geopolitical, and social factors, which enabled this extraordinary period of falling prices. But our view, again, is that with the exception of technology, which perhaps, Tom, we can come back to, politically, in the form of the dominance now of the anti-globalization, anti-immigration, and populist narrative that now dominates in the West, geopolitically, that we've moved away from the previous regime of 30 to 40 years of Pax Americana, where we had one global superpower and no real challenge to either them or their ideas, to a new geopolitical order, which we sit in today, a bipolar order, a world around China and a world around the US, and the subsequent sort of balkanization of supply chains that inevitably results, which are, of course, inherently inflationary. And socially too, nodding our cap to the fact that this extraordinary period of falling prices was due in part to a number of significant social one-off events over that time frame, which simply can't be repeated again. China cannot re-emerge. The trend of higher female participation in the workplace as it became more socially acceptable for dual income families in the West. Those types of impacts and the impacts they had on the labor market and the subsequent disinflationary pressure they exerted seem unlikely to repeat themselves. So in summary, our contention is that the rapid surge in prices that we've all just witnessed has been catalyzed by the extraordinary events of the last 15 months, but it is not its cause. Its cause is that we are in the midst of genuine regime change, a once-in-a-generational shift to a new inflationary environment. And this really matters. And it really matters for three reasons. Firstly, because when you look back through the sweep of time, these changes in investment regime are historically very disruptive for asset prices. Secondly, because for choice, no one would choose to start from this point if you're undertaking such an investment regime change. Interest rates are close to 500-year lows. Equities are generally expensive on a variety of different valuation metrics. And finally, and hopefully this is something we can pick up a bit more in our Q&A session, this investment regime change will have profound consequences for asset allocation, where the headline is, quite simply, a new investment regime, new waters within which we will swim, will require different investment winners and different investment losers that have been the form for the last 40 years. So Tom, I hope that was enough to sort of hang my hat off, and let's break to some Q&A.
Yeah, obviously you made some really interesting points in there. The big theme was change of this financial system. Could you elaborate on what you mean by that? Obviously, we used to quantitative easing for some time now. Could you elaborate more on what this new financial system you think might look like?
Yeah, no, I think this new investment regime will be defined by, in effect, an awful lot more examples of what we're seeing right now. So what we're seeing right now is a spike in inflation, an injection of inflation risk back into the financial system, the likes of which, quite frankly, we haven't seen for 40 years. And that's really significant because you've now got a whole generation of investment managers, a whole generation of advisors who quite simply are just not familiar with this type of risk. And my fear, and Ruffer's fear, is that the current path that the consensus narrative is on is that they're going to dismiss this first inflationary skirmish, if you like, as transitory, isolated, and not important. And then, you know, over the next 12, 24, 36 months, our view is that we're likely to see more examples of exactly this type of return of inflationary risk. And now is the time where advisors and investment managers should be actually taking the time to prepare for this new investment regime, which will be fundamentally very different in its structure and also in the investments which will be needed to thrive within it.
You just mentioned there that, you know, your fear is that people might dismiss these inflationary fears. I hosted a webinar last week with a fund manager on who said inflation for him was a short-term concern, but nothing much over the medium to long term. I'm assuming you don't agree with that statement.
Yeah, I mean, the view you've just described is what we hear an awful lot. And in the short term, if you take this surge in prices in isolation, then, as I said, you know, I would not be remotely surprised. We would not be remotely surprised if we see a lot of that price action reversing towards the end of this year and at the start of next year. But the mistake is doing just that, viewing it in isolation and not seeing it within the context and considering some of those other structural drivers which give us such a strong conviction that this is actually the foothills of something much more significant. And it would be fascinating to have a conversation, you know, with that person around some of those structural drivers and get his take. Because let's just take the political narrative. We were both talking off the show about how we'd both read history at university. And in my first year at university, you had to do another module outside of history, and I did a geography one. And pretty much the whole narrative in that year's course was talking about the upside of globalization. Globalization just wasn't even questioned as ever being a bad thing. But like anything in life, you can have too much of a good thing. And here we find ourselves sitting in 2021, and actually the negative side effects of too much globalization, which one of the principal ones have been the widening inequality between those people who are fortunate enough to have assets, fundamentally the clients of advisors, the clients of investment managers, who have been able to partake and benefit from this golden era that we've just lived through for investments, where they've seen their portfolios appreciate sharply in value, they've seen their properties appreciate sharply in value, they've seen their fine art appreciate sharply in value. But for the majority of people, young people in particular, people working in the public sector, you know, let's have it out.
Yeah.
Let's talk about it. You've been locked out of, you know, we've been locked out of that asset price appreciation because fundamentally our only asset is our labor. And that stoked a lot of anger, a lot of resentment, and has driven the political narrative that remains such a dominant feature, the politics of Donald Trump, arguably a lot of the Brexit vote action too. So this type of change, literally in the waters within which we swim, is unquestionably inflationary, because what this reversal of the globalization narrative means is that more jobs are being reshored back to the UK. So in terms of labor costs, you're not paying low cost wages out in Asia anymore. You're having to pay higher wages to workers in the UK, et cetera, et cetera. And it's these type of structural inflationary drivers that we need to get people to stop looking at the day-to-day moves on their screens, but sit back and look at the bigger picture and say, what is going on here? You know, don't be the young fish saying, what the hell is water? Be the old one who's aware of what's going on.
Yeah, I mean, you've just given a strong, detailed, convincing answer of why to look at the bigger picture. Does it surprise you there are asset managers out there and people that look after money that you know, they're focused on the short term and dismiss these what you call structural drivers, I think.
I mean, not remotely. I think the whole industry is wired to short-term investment. We all report quarterly. A lot of the consultants want to see 12 months, 3 months, and even 5-year reports. Jonathan Ruffer, who obviously founded the business I'm lucky enough to work for, has a great story about how right at the start of his career, when he had just started Ruffer, well, at the start of his Ruffer career, he was approached by an organization to be a trustee. And the other trustee said to him is, we'll want to see you regularly to get a view on performance. And Jonathan said, that's fine. And he said, so the first time we'll see you is in 15 years time, and then we'll take it from there. And I'm not necessarily saying that's the way to go, but I do think the industry has lurched. I'll be really interested to hear from the advisors, on the call, whether they agree far too much to 12 months, 24 months, 3-year type returns, which, as you say, prevents us from being able to look at a long term.
In terms of this change of financial system going forward, a more inflationary environment, the Fed in the US at the moment is targeting 2% still, I believe. That they think they consistently can keep it averaging around 2% inflation. Correct. Why do you think they might fail to do so, and it might go harder than that?
I think first and foremost, the inflationary genie is slightly out of the bottle already. I mean, let's look at the amount of fiscal spend that happened in the US economy that I mentioned over the last 12 months, akin to 20% of GDP. And not only have we got that quantum of fiscal spend, but that's now going on in tandem with ultra loose monetary policy. So I think, there is a genuine case to be made around the fact that it could be too late. We're already well into this process. I think, interestingly, there's a psychological element to this too, which is when the crowd, the public, potentially wake up to the fact that their savings are potentially, regardless of whether they are or not, but are being undermined by very loose monetary policy. The purchasing power of their money isn't what they thought it might be. Then the truth about money and inflation, and this is particularly clear in emerging markets where you see it most vividly, is it is a confidence game. And once you cross that tipping point where people decide that the £5 in their pocket isn't going to spend or isn't going to buy them the equivalent £5 worth of goods in 6-12 months time that it buys today, then they will spend it. And once people start thinking like that, I don't think there's an awful lot that central banks can do about it. So a combination, I think, of potentially the inflationary genie is already out the bottle. I think it's going to be very difficult to wean the market off coordinated loose fiscal and loose monetary policy from here. Added to which, politicians have now found the magic money tree, and they're not going to take their arms off it very easily. Look at the, the promises that around infrastructure, around greening the US economy. You could argue they're just another name for big fiscal spend. So that and the psychological element, in effect, make me feel that central banks will talk the talk, but whether they can then walk the walk, we'll see.
In that answer, you just mentioned people's savings being undermined. So let's kind of take this conversation to what practical implications of this potentially inflationary environment. What does this do to multi-asset portfolios, and what do you think asset managers should be doing to help protect advisors and their clients from these potentially inflationary scenarios?
Well, to deal with the first part of your question, what do I think it will do to existing portfolios? The real rub about this investment regime change and why it's so important is that not only has the dominant investment model for the last 40 years been a very successful one, and what is that dominant portfolio model? It's a 60% equity allocation, it's a 40% allocation to bonds. And the truth is that over the 40-year period, equities have delivered stellar returns and bonds have delivered very strong returns too. So the overall return has been very strong. But the real magic has been that in moments of stress in financial markets, equities and bonds have actually been negatively correlated. So bonds have risen when equities have fallen, which has meant that the traditional 60-40 model has not just delivered good returns, it's delivered excellent risk-adjusted returns too. But fast forward and insert that model portfolio into the new investment regime, where we're likely to see more inflation, rising interest rates, and potentially what you see is a very different conclusion. Because imagine that inflation in the UK stabilizes in and around 3 or 4%, for example. The US 10-year government bond today is trading at 1.4%. Who is going to buy the conventional bond if inflation's at 3 or 4 and it only yields 1.5%? So at the very least, that yield is going to have to move up to match the new inflationary norm. As yields go up, it is a mathematical certainty that the price of bonds go down. Added to which, there was a really interesting bit of work done by Minac Advisors, which reaffirms something we've long thought. But in an inflationary backdrop, the negative correlation between equities and bonds beyond about a 4% level breaks down and becomes positive. So now not only are bonds losing value in the inflationary environment, but in moments of market stress, they've got a positive correlation with equities. So you could be in the terrifying situation where both your main asset classes are falling in tandem in a shock in a new inflationary environment. So this is why this new environment needs to be taken seriously. And many of the lessons that have just been assumed as correct over the last 40 years, I think, need to be rethought. And to get through the environment that I think we're unquestionably heading into over the next 5, 10, 15 years, or what have you, you're going to need a lot of imagination, and you're going to really need to understand what this new regime is going to look like. And so for us, that means allocating to inflation protection, principally through owning some gold, and what we call at Ruffer 21st century gold, which is index-linked bonds, where both the principal and the coupon rises with the rate of inflation going up. And if the price is right, then digital assets, digital gold in the form of cryptocurrencies may have a role to play in that in time. But on the other side of the ledger too, you're going to need to rethink your equity book, because a lot of the equities which have thrived over the last 10, 15, 20 years are the very equities that could potentially suffer in this new investment regime. Because a lot of the growth style equities, those big tech companies that have done so well, their valuations their very high valuations owe a lot to very low discount rates, which is a function of interest rates. So instead, I think your equity book needs to start reflecting names that will benefit from rising levels of inflation, rising interest rates. And I think, financials, banking names could be a really interesting place to go. And then just it's a rather long answer to your question, Tom, but in the final place too, as I said, I think this regime change is going to be disruptive. So you need to think about some genuine protection too, to get you through what could be quite a rough period of time.
There's a lot of things I can pick up on there, but would you kind of say that the kind of reliance there has been on 60-40 portfolios, do you think that needs to, perhaps go away entirely, or just, advisors and clients need to be wary that it might not be a suitable portfolio going forward?
I think it's difficult to make a case for bonds if we're right about this regime change for the reasons I discussed. The correlation benefits won't be there, and the price is vulnerable because of that yield correction. Equities should work, will have a role to play in that, but potentially a different type of equity to the one that we've all got used to.
So if bond isn't such a great diversifier potentially, you mentioned it a minute ago, cryptocurrency. Ruffer made a few headlines. I believe you bought it in November and then sold in April for a tidy profit. I think something like 200-300%, was it?
Yes.
Yeah.
You're kind to mention it.
Yeah. Obviously it made a lot of headlines, and people are very distrustful generally, I think, of cryptocurrency, particularly advisors. I don't think I'm wrong in saying that. Do you think you'll be using those kind of assets again? You know, they're very volatile in price. What would make you want to buy those kind of assets once more?
It's a good question. We have, because we've had this inflationary view around regime change for a number of years, we've been thinking a lot about how we can protect against inflation. And as a result, we've been very interested in digital assets, cryptocurrencies for a long time. I think one of the factors that pushed us into action in November was we also saw the potential for institutional adoption of cryptocurrencies as we came to the end of last year. And my gosh, did that play out very significantly over the next few months, of which the poster child for that was Tesla, where they came out and said that, you know, they would accept payment in cryptocurrencies. So that was sort of the short-term driver. The longer-term driver, and which could well, you know, see us looking at this space again, is that in a world where we fear that central banks and governments are going to be increasingly acting in sync together and potentially undermining the value of your savings in paper currency, then we think it is likely, possible, maybe even probable, that particularly people of, I'm not going to say my generation, your generation, will look to move their savings outside of the hands and the influence of governments and authorities and put it in a place where it can't be devalued, because ultimately Bitcoin has a finite number of coins. So
would you say it's driven by a big cultural shift? Is that what you view as the big driver here?
I think it's all part and parcel of this regime change within which we're within which we're living through, but also just the growing influence of technology and how we increasingly go to the internet to source everything in our lives, and that has now just evolved into potentially how we save our money too.
So talking about bonds not being such a great diversifier, having to go to different assets to perhaps get that diversification in portfolios. Is that your greatest concern, the lack of diversification, or is it inflation itself? What's the driver of your day-to-day worries?
Yeah, I think it's a good question. I think for advisors, what's really important to point out here is that a lot of diversification is sought by unintentionally just diversifying between different people. But what you're going to really need to get through what's coming next is genuine diversification of strategy. And maybe we could just put up the slide with Ruffer's long-term performance track record on it to illustrate a point, which is, I think, one of the most powerful things about potentially allocating to Ruffer is that we offer genuine diversification of strategy, not merely diversification of people. Now, how can I illustrate that to you? This chart shows our long-term performance track record. It has four lines on it. The yellow line, which is the return an investor would have got had they placed their money on deposit in a bank. When we started our one strategy back in 26 years ago, it annualizes at 3%. The blue line shows the path of the FTSE All-Share total return as a proxy for the UK equity market over that period. The orange line is a proxy for our industry. The green line is clearly the Ruffer return. But laugh, because otherwise I wouldn't show it to you. But the point is not actually the overall level of return. The point is how in those green vertical columns, the dot-com bust, the credit crisis, and the COVID-19 crisis, at moments where you've had inflection points in markets, then the green line has operated in a completely different way from either the equity market or the orange line, the industry. And so to answer your question, the headline would be, you're going to need diversification of strategy, not merely diversification of people who are fundamentally doing the same thing.
Yeah. And do you think through all this, advisors and perhaps you as the fund managers, do you need to be more realistic about potential returns for clients after the few years we've had, relative to to inflation?
Yeah, I mean, I think we absolutely do. We've come out of this golden era where returns and returns on capital have been phenomenal, and I think we do need to calibrate those, going forward. Yes, I think that's right. I think the new environment may well see higher nominal growth, but what will be your real growth above that inflation? That's going to be the key element. And we can take this chart down now because I feel a bit embarrassed we've got it up so long. But what I would illustrate to make reinforce the point you're making is that over the 26-year period, Ruffer has annualized at 9.2. But for the majority of that period, remember, interest rates were 5%. So what was the return above the risk-free rate? Well, the difference between 5 and where we currently are now. And if that risk-free rate is rising, then it's that difference, the real return, that's what matters.
We've got a few questions in now. Just to remind you that there is I think agreeable is the word Ruffer used, an agreeable case of wine on offer. You go into a raffle. If you ask a question, your name's put in the raffle, and someone today who puts a question through will win that agreeable case of wine. I'm not entirely sure what agreeable exactly means, but
I'm not sure. I'm sure it's
edible.
Good, yeah. drinkable.
Yeah.
Let's go with drinkable.
So yeah, I'm going to see a few questions through. Bertie, I think I remember you saying technological innovation was a key driver you were thinking here. What do you mean by that earlier?
Yeah, it's a great question, whoever's asked that. One of the big challenges to this regime change concept, thesis we have is that you won't be able to move into a higher inflationary regime because technology and developments in technology are such a powerful disinflationary force that how on earth will you ever be able to achieve fundamentally higher inflation going forward? And the first point I'd make to that is, broadly, we agree the advances in technology, or we agree insofar as saying the advances in technology have undoubtedly, in the AI space, the robotics space, the advances in computer sciences, been very disinflationary. But I think the challenge to this point, and to why I absolutely think we can continue to have significant advances in technology, but also see the regime change which we've discussed in such detail, is because technological innovation typically is measured in is measured in decades, not years or months. And that means that you can have technological innovation going on in the background, exerting disinflationary pressure, but still see big spikes in inflation. And what I would, the example I'd give to you is what's going on right now. We are living through a period of extraordinary technological advance, yet we've got the highest month-on-month rise in US core inflation for 40 years. So to say that you can't have inflation just because you've got technological innovation going on in the background is intellectually questionable, I think. Added to which, I would say that innovations in technology, in terms of their impact on prices, is largely dependent on the political, geopolitical, and social context within which those advances in technology are made. Because in a world setup which we currently have now, which is increasingly anti-globalization, anti-freedom of movement of people, anti the freedom of movement of ideas, then I think you can make quite a strong case for saying that the diffusion of technology and the rate of adoption of technology across different businesses just simply won't be as strong as it has been previously. And I think finally, and apologies for a long answer on this, but it is an important point because it regularly, I think, comes up. I would just highlight that I think going forward too, policymakers are going to take a much more nuanced view to technology more generally. There is definitely a feeling that while the political elite realize they have to grasp technology and its benefits in order to compete on the world stage, they also realize very firmly that this same technology is actually undermining the base on which a lot of their political power is built. I mean, have a look at how Donald Trump was deplatformed by Twitter, have a look at the role that cryptocurrencies are having in destabilizing the existing regime. So I think you're going to see more regulation of tech, greater antitrust type movements going forward, which means that even though technology will remain an important driver of disinflation, I think all of those factors for me make quite a compelling case to say that it won't be as profound an impact as it has been previously.
And going through this inflation regime, which broad investment themes like growth or value, etc., do you think will be the winners here?
I think in this inflationary environment to come, it will be more the economically sensitive, value type or parts of the equity market that have been associated with value that will likely do better. It's a good question. If I was to, identify one particular sector, I think finance, I think banks have had a torrid decade. Now, if we're moving into a new environment where interest rates are likely to be rising, maybe not that far, but certainly up off the floor where they are currently, interest rates rising are a big driver of banks' profitability. So I think value over growth, certainly. And within the value space, I think energy looks really interesting. Commodities, they will benefit from a rising inflationary environment, and financials. In short, all the places that people don't really want to go right now, which makes sense because the last 40 years has put the spotlight on other corners of equity markets. And with this regime change, I think all of that is likely to invert.
And you've been emphasizing the regime change and the transition. Will there be winners and losers within the transition? And then once we reach the inflationary regime, era, will they be different?
Yeah, it's an interesting point. A number of equities, looking back at the example of the 1970s, and let's be clear too on this inflation point, we're not talking about 1970s style absolute levels of inflation. What we're talking about really is a process of financial repression, which is the relationship between inflation and interest rates. And our strong conviction is that interest rates will potentially move higher, but stay relatively low, and inflation will move significantly higher above that. And in that environment, what one tends to see is that as financial repression and inflation becomes more exaggerated, then equities can, especially ones on the high valuations, derate. But once that inflation rate becomes more stable, then companies can adjust and find ways to cope with that.
We've got a question in. I don't know if you want to answer this for compliance. You might not want to answer for compliance reasons or something. But someone asked, what are the, I guess, styles of funds would someone want to own to complement the Ruffer Total Return Fund? You feel free to not answer it if you don't want to.
I mean, I'm not going to mention names. I'm very happy for that individual to get in touch with Toby Barklam or any member of our team who will be on firmer regulatory ground at that moment than I would be. But what I would say is I would be looking out for funds who have a lot of inflation protection built in to their into their strategy. And I would also be looking out for genuine protection being built into their strategy too, in the form of potentially options, derivatives, because a feature of the investment regime we have been in is that a lot of conventional asset classes have become increasingly correlated. And therefore, to get genuine protection, you're probably going to have to start looking in the unconventional space, which is the slightly murky world of options and derivatives. And in Q1 of last year, when the S&P fell 40%, our portfolio actually made money in that quarter, and that was largely down to the solely down to the unconventional protections we held that provided genuine protection in that moment. And so I think, in answer to the question, without mentioning names, I would be looking for inflation protection and then genuine protection within those multi-asset class funds.
And then another question, someone says, is part of the problem with bonds and fixed interest the need at the moment for DB schemes to keep purchasing them for actuarial purposes? I know that insurers have to buy up lots and lots of poorly yielding government bonds for kind of the same regulatory reasons.
Yeah, I mean,
do you think they're the main drivers of this poor bond environment?
I mean, in short, the bond price has been incredibly strong for a long period of time, and that is contributing to it. I think very real questions will have to be asked if that key asset class, which is responsible for so many people's pension savings, if that starts to go in reverse, then that could be that may be the catalyst for a rethink.
And I'll give you one more question, because I know that advisors are very busy and they'll want to be getting down the pub early for 6 hours of preparing for the big match tonight.
Yeah, quite right.
There's a question close to home of how inflation affects financial services firms, particularly perhaps advisors, because they often charge a percentage of client assets rather than flat fees that are already charging. Obviously, some do both, some do one or the other. But how does higher inflation affect financial advisors' revenue going forward?
Yeah, I mean, I think the undertone of your question is really interesting, which is making the point that this is going to affect everything. Let's not just silo this change in investment regime merely to the investment world. It's going to have very real life ramifications across a range of different things, of which businesses and financial advisor businesses are absolutely not going to be immune from that. So I guess, I appreciate I'm speaking to the experts who are on the other end of the call about the nature of a financial planning business. But I guess what bad looks like is if you maintain a model portfolio around a strategy which isn't going to thrive in this new investment environment. So if you stick to your 60-40 equity bond portfolio, and as you rightly say, if you're taking your fee as a percentage of that model, and then that model starts losing value, then your revenue is coming down pretty hard. And then on the other side of that equation, if you're starting to get inflationary pressure coming through from higher wages and just higher costs more generally, then you're getting pretty significant margin squeeze. And that looks pretty unattractive. So it's a really interesting question, because it absolutely has linked what's going on in the investment world to the real life corporate world. So yeah.
Brilliant. Thank you very much, Bertie.
Pleasure.
That's all we have time for today. Thank you for your questions, and thank you again to Bertie for joining me in the studio today, and for letting me and you folks at home grill in with our questions. On that note, if your question didn't get answered, Bertie and Ruffer will do their best to do so after the event. And before we close up, I should assure you that your CPD will be delivered tomorrow. Now, I have the bowl of names of those who ask questions. So I will pick one out here. It's been delivered to me. Ooh. And the raffle winner is Kevin Neal of Lawrence Anthony Associates. So congratulations to our agreeable case of wine winner, Kevin Neal. I'm sure Ruff will be in touch shortly about that. And now, before we sign off, let me just remind you of some dates for your diary. In September, a professional advisor will be back on the road from the 13th to the 23rd of that month, taking a multi-asset masterclass around the country. We'll be going to Harrogate, Knutsford, Birmingham, Bristol, and London. You can find out more about that on the Professional Advisor website under the Events tab. Then on the 7th of October, we have our flagship PA360 event in London, where we'll bring together all the topics and debates key to financial advisors for a one-day festival of financial advice. And on the same evening as PA360, on the 7th of October, we'll be hosting our first live awards event for 18 months, as we'll gather together the profession's best for a gala dinner in London to host the Women in Financial Advice Awards. Again, you can find out more about all of our upcoming events by clicking on the Events tab on Professional Advisors homepage. So that's it for today's session. All that remains is for me to once again thank Bertie for his presentation and for answering all our questions. But of course, our greatest thanks go to you, our readers, for your company this lunchtime. I trust you found this helpful and worthwhile. If you did, then we'll look forward to seeing you again soon. And of course, enjoy the big match tonight. It's coming home.